So the 1.1 million that we saved was 900,000 on VAT, 180,000 at that time on stamp duty, and 125,000 on corporation tax on the purchase. Forget what I'm just about to save you, double whammy on the split as well. Because what happens with property when you split it, if you do it properly, I emphasize properly, and that's not a 2-minute conversation, there's a few experts on that, is you can get individual component value. So you've got to do this. And if you do the refurb properly, you don't lose the value on the split, because the accountancy and tax are different. If you haven't got a specialist property accountant, I'm sorry, but you are losing a lot of money. And if you haven't got a tax advisor who understands property as well, the cherry on the top is exploding really big time. So this is why we have this structure for this type of strategy. It's not for every strategy. It depends on your circumstances, where you start. But what we're doing here is we're mitigating all the different aspects, because it goes back to the 70 to 90% that I was talking about. Have you noticed suddenly that's where the 70, 90%, because if you bought it, 40% IHT building up if you don't mitigate it. The next problem you've got is when you buy it, SDLT, stamp duty, land tax, corporation tax on any gain or any profits. By getting capital allowances, in that case, in his example, the first £500,000 of profit, tax-free. Did we hear about that? Okay, that's corporation tax. Then, if you structure it right, you get an income tax plan. You pull out the money in a smart way. You've mitigated inheritance. And if we're still ready, VAT is your friend, because when you convert, not only does it have special rates of VAT on the work, also on the disposal, depending on timing, you keep all that fund.